Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King-Holland. Let's get you up to speed on the market action. We're rounding out what has really been a down week here for the major averages. You're looking at the Dow, not far from the flat line today, but on track to close the week off more than 2%. The S&P and the Nasdaq both headed for the third down week in a row, and both those averages tracking for the worst month that we have seen since December. And we certainly have seen investors maybe rethink what could come from the Fed over the coming months. More and more talk or more and more thought here that we could potentially see another rate hike before the end of the year. And that has also been dictated in the moves that we're seeing in the bond market. The bond market driving a lot of this week's action. When you take a look at yields, yes, we're seeing a bit of a relief today, but the 10-year yield well above 4% and not too far from yesterday's high.
All right. Well, markets are little changed, a little bit of sleepy action this Friday as the major averages head for weekly declines. And the worst performer is the Nasdaq. Jared Blickery is on the floor of the New York Stock Exchange with the details. Jared?
Hi, let's take a look at the Wi-Fi Interactive here, and we can see for the sector action for the week, we're actually seeing tech down the least, but what's down the most, that is consumer discretionary. That's XLY, down 4.3%. Also, another mega cap sector, communication services, down 3.2%. And I'll show you this briefly in the Nasdaq 100. What pops out here? Well, NVIDIA for number one, that's up about 5.8% now as I speak, and that is in the tech sector. Some of these other mega caps, by the way, not in the tech sector. Amazon and consumer discretionary, that's the worst off this week. And then Alphabet and Meta, those are in communication services. But I was taking a look at some of the cumulative losses for various mega caps from their 52-week highs, and all except Tesla had these 52-week highs relatively recently. So these red bars are representing the return. So for Apple, for instance, it's down about 12% from its 52-week high. And the green bar, that tracks the market cap loss. And that's about $380 billion lost for Apple alone. You can see for Microsoft, kind of a similar story, down about 13%. And then let's call that $375 billion. Tesla, those bars look about even. One of them represents a drawdown of 30%, the other is a drawdown of $300 billion, and the list goes on. To the very end, where we have Amazon and Alphabet, Google, those are kind of the outliers, the least dirty shirts in the laundry basket being our heat maps that we were just looking at here. Really interesting week, especially to see tech the least bad sector. And let's take a look at what's happened in the bond market, because that's been informing and dictating a lot of the price action that we've been seeing in equities. 10-year T-note yield, that is net up for the week. And you can see we just reached a multi-year high. I'm going to put a max chart. We haven't seen a number this high, 4.26, 4.3% since 2006, 2007. You'd have to go all the way back here. So we're talking about pre-global financial crisis, pretty heady, just raw numbers that we're looking at. And as yields go higher, we know that that tends to weigh on growth stocks more. It tends to weigh on stocks like Apple, and even with a strong balance sheet there. Also want to take a quick look at volatility. Let's take a look at the ICE Move Index. This tracks bond market volatility. That red candle there is a little bit of a downbeat, so that's actually good news. Less volatility in the bond market. But we have seen the VIX tick up a bit, and appropriate to talk about that since it is options expiration day. We had index options expiring on the open, and then later this afternoon we are going to get the individual issues expiring on the close. So all in all, a bit of a negative week, but interesting to look at what's been happening with those mega caps, guys.
Indeed. I love that phrase that you used, the least dirty shirt in the laundry basket. It's a favorite of mine when we use these Wall Street adages. Jared Blickery, thank you so much.
The rates debate is on. Fears of higher for longer rates driving the risk-off sentiment for investors. The bond market staging a bit of a rebound today, but yields still remain high. The 10-year yield pulling back from the highest level that we've seen of the year. We want to welcome in Lisa Erickson, U.S. Bank Senior Vice President. Lisa, it's good to see you. So we're getting ready to wrap up the week. We've seen a massive sell-off in bonds. We've seen equities come under a bit of pressure as a result. Investors trying to figure out what exactly is ahead for the Fed. But when you take a look at the move that we've seen in the bond market, what type of risk does this then signal for equities?
Certainly, this upward march in yields has been concerning for equities. And to your point, it's because you really have a relatively lower risk asset, offering some nice income to investors. And so on the back of that, and also with the implications for the broader economy, where if you have higher borrowing cost, again, it makes it harder to generate that growth going forward. It certainly has been a concern for the stock market. Now, fundamentally, when we look at it, our expectations is that really all other things being equal, bond yield should start to have some more momentum downward, only just because when you look at underlying macro activity, we have seen it continue to slow. And generally, when you have lower demand and lower growth, you're going to have lower rates. But again, there's some technical momentum behind investors just really continuing to push those yields up. So it's something that we'll want to monitor.
So speaking of monitoring that, though, is fixed income the play to hide out in if we expect the Fed to keep up a tightening course?
Right now, Diane, we're actually neutral on fixed income, meaning that for our clients, what we recommend is whatever is their long-term or strategic allocation to fixed income, that they just stay put at that level, that they neither overemphasize it at this point or underweight it. And really the reason why is because while you're getting some very nice yields on fixed income, we do have this technical momentum continuing to potentially push those yields up and push the underlying bond prices down. And it's still yet unclear when the Fed will pause and pivot. So far in that tug of war between market expectations and what the Fed actually is doing, the Fed has won out. And so the Fed has stayed on that sort of higher for longer course, more so, and really been able to stick to that, even though the market keeps expecting them to pause and pivot.
Lisa, how much higher do you see the 10-year yield heading?
Well, it's hard to say exactly how far it is going to continue to move on. Certainly, if we continue to see a breakout, there is some resistance level at 5%, but 5% is still a pretty high number compared to where we are now. So it is, again, something that we're just going to want to continue to monitor. Again, though, if we look at the underlying fundamentals, we really see that all of those signs would point to yields beginning to come down over time. So it's that push and pull between current investor sentiment and what the underlying fundamentals on macro would tell you.
And then when you think about things that we're continuing to monitor, of course, it is the actions of the Fed. And next week, a big focus is on Jackson Hole. So what are your expectations for what we could possibly see come out of that?
Well, certainly in the last press conference, Fed Chair Powell really emphasized optionality and data dependence, really not making a commitment either way to what would happen with potentially another rate hike or if a pause would happen at that meeting. And so I think really the impetus is for him to keep that optionality open. Investors, including us, will certainly look for clues on anything he may say about ultimately where he wants to see interest rates end up. And again, other factors that the Fed is looking at to determine, again, when to pause. But since there is just so much data and time between now and the next meeting, the most likely odds are that he's just really just going to keep all options on the table.
Lisa, we're getting ready to wrap up second quarter earnings season. And when you take a look at the numbers of results that we got in compared to what we had been expecting heading into this earnings season, certainly showing that corporate America holding up much better than many analysts had feared that we would see. What's been your takeaway and how this positions us then for the final months of the year?
We have had a very solid second quarter earnings season. And if you look both at the percent of companies beating and the amount by which they beat, it was a very respectable amount. And so what companies are really showing is that they've been able to adjust to some of the difficulty in inflation pressures, whether it's in their cost inputs and also how they price back to consumers, as well as keeping volumes reasonable. When we go under the hood beyond that broad level, we are seeing, though, some signs of slowing. And so, for example, consumers are spending somewhat less on discretionary and focusing more on the essentials. And we even see a little bit of hint that some of that revenge spending on services is beginning to tick down a little bit. And so really the question for us going forward is, how long can the consumer continue to hang in there? Certainly there's some excess savings, but how long will that continue to propel them forward? And so those are some of the key questions we're going to want to see if that second half expectation right now, which is by the consensus for corporate earnings to be able to resume more of an upward trajectory, will actually happen.
And to your point, Lisa, about the weakness that we've seen, or some of the slowdown in the strength of the consumer that we've seen in some of these earnings. Like, for example, one of the places that stood out was Target this week. What is the expectation for the balance of the year when you think about the potential for, one of the things we've talked about a lot is the resumption of student loan payments and what that could do in terms of the strength of the consumer, and also, to your point, with that excess savings starting to wind down, do we think consumers still hold up, especially when we see that there's been still job market strength?
Well, we're really at a neutral position right now on the U.S. equity market. And to your point, it's really because you've got these puts and takes. And so on the take side, certainly we do have the fact that it is going to be somewhat of a tougher road for consumers, with inflation having come down but still high. The student debt payments needing to kick back in, and excess savings we certainly know has come down over time. These are all headwinds to continued consumer behavior. On the other hand, we still have a very tight labor market, and we have an elevated number of job openings relative to the number of unemployed. So those bode well for the consumers being able to maintain their income and spending. So again, it's something that where we feel staying at that typical position you have in U.S. equities makes the most sense right now, and continuing to watch how that data unfolds.
Lisa, what about when we're talking about portfolio positioning right now? Obviously, a lot of focus in the first half of the year was surrounding the AI rally, tech being that outperformer. We've seen a bit of a rotation and a broadening when it comes to leadership. But when you're looking at tech at these current levels, are you still seeing a buying opportunity?
So for investors who are looking out more than a year, we certainly see technology and some of these more secular growth areas, like specific areas within communications or specific areas within consumer discretionary, as attractive. And the bigger picture why is many of the trends that we've seen play out over the last years, with increased use of cloud computing, now increased momentum, to your point, Shauna, around AI and machine learning, and continued consumer demands for anytime, anywhere connectivity. These all should continue to bolster these kinds of names. So again, for investors who can ride out maybe some of the nearer term chop as people become concerned about the wiggles and waggles of inflation and where policy may head, it continues to make sense to invest in some of those sectors.
All right, Lisa Erickson, thanks so much for joining us. Have a great weekend. U.S. Bank Senior Vice President. Thanks, Lisa.
All right, another risk-off play. Bitcoin falling further into the red, trading around the 26,000 level. Now it's down 6% on the session. Some of the losses being attributed to a Wall Street Journal report that revealed Elon Musk, SpaceX, wrote down the value of Bitcoin, of the Bitcoin it owns, by $373 million over the last 2 years, and has sold the cryptocurrency. But crypto was already under pressure this week amid that risk-off sentiment play that we've seen. We've seen just a lot of downdraft affecting many of these riskier assets, Shauna. I mean, and it's not just Bitcoin. You have Ethereum under pressure. That's down more than 4% today. One of the levels that we've been watching when it comes to Bitcoin is that 25,000 level. Now, the bullish case was if it headed back towards 28,000, and right now it's heading in. It briefly broke around that level today, so that is just a key level to watch.
Yeah, 25,000 is what the key level that a lot of are watching on the street. We are still about $1,000 above that level, but like you said, this is a play that has been under pressure now for several days. We're looking at a weekly loss of just about 11%. When you take a look at some of this data that's coming out, CoinGlass had data out saying that liquidations exceeded $1 billion in 24 hours as prices fell this week. So yes, we are seeing a decline, but putting this back and putting it in perspective for everyone, remember, we have seen a massive run up since the start of the year. It's still up just over 60%. So yes, we are seeing a bit of pressure, and you do want to be aware of trends, especially when it comes to Bitcoin here, as we still struggle to make sense of some of the activity and some of the trading momentum that we do see. So yes, a reason to be a little bit cautious, but still we have come a very far way
from
since
the
January 1st.
winter. Exactly. That's right.
Yeah, let's also take a look at some other movers today, and Chinese tech stocks under pressure amid rising fears about China's economy. So regulators once again stepping in to support financial markets. This time, officials asking banks to intervene on the yuan and also ask some investment funds to avoid selling. The move follows the People's Bank of China cutting rates earlier this week, and its biggest cut that we've seen since 2020. So yes, we're seeing some pressure once again on these stocks today. JD.com and Alibaba among the worst performers here for the week when you take into account JD.com off just over 9%. But the data that's coming out of China, it almost seemed to be getting worse by the day this week. And the youth unemployment number, the fact that they're not reporting that, at least suspending it for now, is a worrisome sign.
Right. And I mean, China's not known as being as transparent, of course, but this is becoming even more opaque in terms of how do you determine how the world's second largest economy is doing. And it's certainly seen faltering and, more shoes dropping one after the other. And you have that real estate worry when it comes to China. And again, the larger concern with these companies, with the JD.com, with Alibaba, with Weibo, et cetera, is just this macroeconomic environment and what that means for how well they continue to do. Even if they did better than expected, they have enough cash to kind of weather the storm. The larger risks are just sending red flags.
Yeah, and it's one of the reasons why we are seeing some of this risk-off sentiment in the markets this week, along with a couple of other factors, obviously. But we can take a look at this data that we got out. We got a reading on retail sales, which was weaker than expected. Industrial production numbers also missed the expectation there. So we're seeing this recovery, lack thereof, in China, obviously really falling short of what many forecasters had anticipated.
What they expected, exactly. All right, we are just getting started here on Yahoo Finance Live. Coming up, while we're still unsure if a recession is coming this year, we may already be in what's being dubbed as a richcession. We break down that concept on the other side. Plus, Disney will countersue Florida Republican Governor Ron DeSantis' tourism oversight district in the latest development of that saga that's plagued the media giant. Stay tuned for all that and much more when Yahoo Finance returns.
Fed officials descending on Jackson Hole next week for the Kansas City Federal Reserve's annual economic symposium will face the question of whether inflation is on a convincingly downward trajectory or whether more interest rate hikes are needed to bring down inflation. Inflation has cooled on a headline basis from a peak of over 9% last June to just over 3% this July. But stripping out volatile food and energy prices, inflation sits over 4%, double the central bank's inflation target of 2%. In his last comments at the Fed's policy meeting in July, Fed Chair Jay Powell wasn't convinced on inflation yet to let off the gas and said he needs to see leftover distortions from the pandemic on supply and demand ease.
Policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate.
Traditionally, Fed chairs have used their speeches at Jackson Hole to put forth major policy messages. This year expected to be no different, with investors hanging on Powell's every last word.
Fears of an imminent recession are dwindling. The Fed saying it sees a path to a soft landing, and staffers there do not have a recession in the forecast. But we may be in what's being dubbed a richcession. The term, originally coined by Wall Street Journal reporter, refers to wealthier members of society feeling the effects of an economic downturn, mainly driven by mass layoffs and white-collar work. Now, earlier this year, we saw the bulk of high-profile job losses across industries like finance and tech. It comes as UBS finds global wealth declined for the first time since 2008 last year. So did the number of millionaires. More than half of them were in the U.S. Joining us now to discuss this trend further is Mark Hamrick, a senior economic analyst at Bankrate. Mark, thanks so much for joining us. So when we think about this kind of concept of richcession, is this a thing? Is this like a real thing? Is there a richcession happening?
Well, I'm not sure I love the notion of having to weigh in with an analog yes or no to that, because I think it's a little bit more nuanced than that. First of all, the figures that you shared there, that's good data, that's good research. That's also for last year. What has happened this year? We've had a strong rally in equities. And so those who are most wealthy are most likely to benefit from that. And it's true. You're referencing the fact that we had a stiff number of layoffs at the beginning of the year, job cuts, job cut announcements, and that did tend to favor the technology sector, financial services, among others. But that is absolutely relented here now as we're sort of in the midpoint of the third quarter. And as we know, the other economic data, whether it's the unemployment report, whether it's jobless claims, that has remained remarkably resilient. And so one of the reasons why I resist the notion of sort of clapping in favor of this concept is it sort of takes a, oh, woe are the rich approach to this issue. And I think that's oversimplification. We still have a huge problem with wealth inequality in this country. And we still have a massive number of hugely wealthy people in this country. But it might be that upper middle class individuals have suffered some of the brunt of the weakness in the job market. But whether they would be considered as rich, I think that is a bit rich, to be honest.
Mark, when it comes to the job losses that we have seen from corporate America since the start of the year, yes, a lot of these names that we follow so closely, especially in the tech sector, have been responsible for the bulk of the job cuts. But when you have a Fed that has left the door open to more rate hikes, and you take a look at the data out today, it's getting a little bit more likely that maybe we could see another hike by the end of the year. What's that going to do to the job market? Are we still going to be able to see a tight labor market under those circumstances?
Well, so when you're saying it may be more likely, that might be talking about a probability of going from, let's say, 20 to 25% at this point. And I'm completely on board with the idea that the Fed is watching the data closely. The Fed doesn't want to limit its options. And that's why I don't necessarily expect this to be an earth-shattering Jackson Hole speech from Chairman Powell, given the fact that we've got to wait until September 20th for their announcement. But to your question, if we were to see rates increase, absolutely, it would be more restrictive. And let's think about the so-called real rate, where the federal funds rate at essentially the midpoint now of 5.375% increases on its own as inflation goes down. And so to some degree, along with the limited, or I should say falling lending, both demand for loans and the availability of loans, as that fourth line in the last FOMC statement said, the impacts of that on things like growth, unemployment, and inflation are uncertain, and it does present a downside risk. But if anything, I think people are getting on board that bandwagon that has to do with the notion of a soft landing. But we will have a recession at some point. We just don't know the timing of that, the depth, or the duration.
Okay, so you say we will have a recession. Obviously, we will have a recession at some point. Even the Fed has basically indicated that it looks like the path towards a soft landing is in sight. And to kind of move away, I guess, from the term recession, one of the concerns is it could be more of an effect, a broader effect than just high-income earners. What is right? So, what is your expectation about like how much the job market could be hurt? Like, could this be a, I mean, we may not see unemployment rise too much, but what is your expectation as we head towards the end of the year?
Well, I like, first of all, that you did reference there what the Fed has talked about, and also referencing earlier that the Fed staff was suggesting that we would experience a recession this year, and Chairman Powell resisted that. And at the last news conference, he said actually the staff now has sort of taken that card off the table. But he has said many times, and anybody else in his comparable position would say the same, that predicting recessions along the lines of what we're talking about is very difficult stuff. And let's think about what caused the last two, which were doozies. We had the great financial crisis and a pandemic. Raise your hand if you predicted either of those two things happening and able to predict where that unemployment rate leveled out in the peak of 10% in the GFC and 14.7 in April of 2022. I think the likelihood is if we do have a recession, let's just say over the next 6 to 18 months, and essentially it's going to be caused by central bankers barring an event the likes of which we can't predict right now, whether it's something geopolitical or something that's truly unpredictable. But if indeed it sort of emerges that the aggressive rate hikes that we've had going back to March of last year, and as you say, could continue here, well, that would likely be the cause. And so in as much as the Fed causes that, the Fed can back away. And I think that's the most important thing, is that central bankers do have an immense amount of power in the control that they wield over economies, as we've seen over the last 15 to 20 years.
Mark, what do you see as the timeline for the decline in inflation? I know that's a very, very tough timetable to put on something like this, but when it comes to the stickiness factor of it, obviously surpassing many forecasters' expectations up until this point, will we see that change at all, that trend at least pick up a little bit when we're talking about further deceleration?
I'm a bit skeptical about that, simply because, we have made, I think, some better than expected progress, for example, with that year-over-year change in the CPI. But I think we don't want to cheer for a recession in order to get lower interest rates, or let's say a mortgage rate average that's below 7% for a 30-year fixed. But I do think that, I think we'll see some solid progress based on what we can expect between now and the middle or end of next year. And where we see consumer confidence improving, that's a good thing. The fact that we have wage growth that's above the rate of inflation, that's a good thing. We are making progress, but it's going to take some more time. And I think it'll be a while before consumers really feel much better about all that, because I do think there does tend to be a bit of a lag. They're still feeling a bit bludgeoned by this most recent experience, for good reason. The worst inflation in 40 years does have an impact on people.
Yeah, and we certainly saw that play out in some of the retail numbers that we saw this week. Mark Hamrick of Bankrate, we appreciate your time. Have a great weekend.
You too. Thank you.
Thank you.
The legal battle over Medicare's drug pricing negotiations is heating up, and it could be heading to the Supreme Court. AARP opposing the Chamber of Commerce's request to delay the implementation of that part of the Inflation Reduction Act. Yahoo Finance's Anjali Kamlani is following this story for us. Anj.
That's right, Shauna. So AARP adding its name to the very short list, the only one so far to file an amicus brief on behalf of the Health Department, and specifically Health Secretary Javier Becerra, who's been named in these lawsuits brought on by multiple pharma companies, as well as the U.S. Chamber of Commerce and Pharma, the large lobbying firm that represents all of the pharma companies. Now, it is, as you can see on your screen, a growing list on the against side, these companies asking for a delay in the implementation and also calling it unconstitutional. A number of these lawsuits name different amendments, including the 1st, 5th, 8th, as well as 9th and 10th in some instances, saying that they need to, that the implementation of the rule would be taking away free speech by forcing, at the end of the day, these companies to sign on after a brief negotiation period, as well as the 5th Amendment saying that it's an excessive, government seizing property by taking the drugs at a negotiated price that they're quote unquote being forced to take. And then the 8th Amendment being cited as excess tax in the fines that would be based or that these companies would face for non-compliance according to Medicare. So all of this put together is really setting up the stage for possibly a long drawn-out battle. Bloomberg just reporting today that legal experts do say it could head to the Supreme Court, especially because of that use of the 5th Amendment and specifically calling it unconstitutional. So it will be certainly an interesting one to watch. AARP saying that the delay of this rule could really harm patients, especially those who need the life-saving drugs at lower prices. They said so in their filing, and they're looking at what else can be done. This battle really is not over. We do expect likely more companies who are weighing their timing of entry, as well as other organizations that could file also on behalf of the for the Medicare pricing negotiations. So all within the timeline, we know that 2026 is that starting period. So time is starting to count down.
Certainly is. All right, Anjali Kamlani, thanks so much for that update. All right, well, coming up, more from our weekly special Retail Evolution, a New Era. The CEO of Poshmark weighing in on consumer demand and also spending trends. We'll be right back.
During Yahoo Finance's week-long retail special, we found out about the state of retail. But what does the everyday consumer think about it? Let's go find out. Have you noticed rising inflation impacting your spending at all? Are you spending less anywhere?
I'm definitely spending less everywhere.
I'm working, I'm making overtime, so my liquidity is a little bit more, so I'm spending a little bit more.
I'm definitely saving as much as I can everywhere and anywhere.
My dollar doesn't go as far as it used to.
I thought I would wait a month after I started school to get a job, but now I'm going to get a job in like a week because I can't really pay for anything.
Are you spending less anywhere that you used to spend more and opting out of certain purchases?
As far as food purchases go, I'm looking to spend a little bit less. I'm not spending as much money on, the frills, clothes, makeup, the fun stuff.
Clothing, I mean, you always look for the sales prices.
Eating out, probably going out with friends.
Where do you feel like you're spending a lot of your money?
Probably clothes. New York City street fashion is intimidating, so I gotta keep up.
I like cooking, so like vegetables mostly. I think they're kind of expensive.
On hair products.
Gasoline, because I drive at home. Alcohol is probably right below gas.
Are you an online shopper or someone that likes to go in the store?
I a lot more online. The convenience.
I would rather do it in person, but sometimes it's just easier and cheaper to do it online.
In person, so that I can try it on.
Online. I hate going to the malls.
I really much prefer in person. I was speaking with the shop owner yesterday, and he said, youngsters don't buy these kind of boho clothes, and if they do, they get it on Amazon.
Everything is becoming more bottlenecked towards the internet, so you're having a lot less choices. Amazon, it's pretty much the way we're going now.
It's been a big week for retail this week, with some companies highlighting a slowdown in discretionary spending, while economic data continues to reflect a resilient U.S. consumer. Joining us now is Manish Chandra, CEO of Poshmark, to discuss this and dive further into the retail space. Manish, I want to start broad first. What is your read on the state of the consumer? Are we seeing a slowdown? Is the consumer still resilient in spending? What is the state of the Poshmark consumer?
The consumer is definitely resilient. We're seeing a lot of robustness in demand. Of course, they're adjusting their budgets as the world tightens up a little bit. So they're definitely being a little bit more economical in their purchases, but the frequency is still very high. So we see a pretty consistent and resilient consumer, which is evidenced by our resilient cohorts that we see in the business.
And one thing that's trending on your site is Taylor Swift. And it seems like this summer we're hearing Barbiecore, Taylor Swift, and Beyonce really driving the economy here. What does that ultimately mean for sales at Poshmark? Are you seeing an increase of people looking for this sort of merchandise?
Yes, I think when you think of Taylor Swift and Taylor Swift concert, we've seen Taylor Swift items go up 57% year over year. Fringe dresses go up 20%, but Barbie brand has trended 340% year over year. So this whole girl power trend is really driving a lot of growth in consumption. And we believe it's here to stay, at least for a period of time.
And I'm curious, you mentioned consumers may be looking to spend a little bit differently and being more careful about those spends. Do you have a read on trade downs and if people are trading down from a brand they maybe used to buy to something else, or trading down for maybe a smaller size product or something like that?
Yeah, what we are seeing is not specific data on brands, but what we are seeing is that as people are investing, so for example, if you look at just the units, our school supply volume is up 50% year over year. Just between June and July, school supplies are up 120%. Kids backpack up 68%. And what you see is a little bit of mix and match of the brands. The great thing about Poshmark and the unique thing about Poshmark is you can find some very premium brands at really great prices, especially if you buy them used.
I want to touch a little bit on those premium brands. Tapestry, of course, they own Coach, they own Kate Spade. We are seeing those brands trend on your site, but the company did signal that they're expecting a slowdown in consumer demand in the next year. What does that ultimately mean for a resale market like Poshmark?
Well, if you think of our market, it's fueled by two different forces. It's fueled on the one side by people shopping the site, but many of our shoppers are sellers on the site, or vice versa. Many sellers are shoppers. So it also gives people a chance to make money. And a lot of our economy is circular. More than half the GMV that we do is circulated back in the site by the sellers. So the powerful thing here is that buy and sell economy is less impacted with these changes in the broader macro consumer demographic.
And I'm curious, I want to know a little bit more about this. I'm looking at Posh Lens right now and trying to figure out how this new search tool works. What does that offer and how is it different from maybe prior offerings for customers when they're using the site?
Posh Lens is something we developed in partnership with our new parent, Naver Corporation out of Korea. And what Posh Lens allows us to do is to literally take a picture and search through these items and find the best matching items. So for example, if you see these unique shoes that somebody's wearing, and if you can take a picture and search for it, you can probably find those shoes, not just from that brand, but other similar looking shoes from other brands that be matching. And that's pretty unique about it because typically when you're looking for a specific set of shoes, you might be looking for one brand, and this exposes it to multiple brands at multiple price points.
Manish, is this using AI? Is this artificial intelligence that we keep hearing about? Is that at work in this?
Yes, there's definitely machine learning and AI working in it. You're using models to understand how images can be mapped into text and text can then be mapped into search. We also use machine learning and AI for our recommendation engine, Just Picked for You, and we feed it into style tags. And as you look at sort of the future of AI, there's a lot going on that we are working on that can be very impactful for the resale community.
As you just noted before, your inventory is absolutely massive when you think about how much you have to sift through it. You know, right now in retail, from big box retailers and beyond, we're hearing about the problem of retail theft, the problem of shrink ultimately, broadly. How do you ensure that people aren't reselling stolen goods on the site?
Yeah, we have a fairly big moderation team as well as a very prompt reporting system. So when we think about our business, a lot of it is built on us detecting, but also consumers and different people reporting. And the speed with which our system responds has been very powerful. If you go back, many years back, 2 or 3 years back, when we had the riots and there were items coming on site, we were able to fairly quickly take them down and also work with law enforcement on that. So we are, as prompt as our community and our systems are, and continue to work and expand that area to make sure that we remain a safe and, a wonderful place for people to buy and sell.
Manish, the last time you were on with us, you talked a lot about influencers and that being a big part of who's buying and selling on Poshmark. And I feel like influencers often give us a look at maybe what's cool now, but what's also going to be cool in a couple months, right? And sort of where those trends are headed. I'm curious what you guys are seeing from those influencers right now and what's most popular.
Yeah, so girl power, as we talked a little bit about, is a huge trend shaping up. The second one, with Messi drawing larger than life crowds on soccer, we have got the football frenzy going up. Soccer jerseys, their sales are up 100% YOY. Adidas Gazelles, their sales are up 68% YOY. And then another trend is SoCal vibes, which is sort of very much like the Southern California thing happening, laid back, surfer chic. And what we see, smiley face print tees and crew necks up 25% YOY, and Abercrombie dresses up 45% YOY. So girl power, football frenzy, SoCal vibes are trends that we are seeing that will continue to drive for the next few months. And as you know, these trends shift very quickly.
What do you think is your biggest concern right now about the U.S. economy and broader implications that we could see on the consumer?
Well, I think the U.S. consumer is fairly robust. I'm sort of more concerned about some of the economic news coming out of China, which ultimately you may think that we're not connected to it, but I think it can indirectly impact our own supply chains and our sort of both demand chains and supply chains. So the global economy affecting the U.S. consumer is more of my worry than the U.S. itself.
And just to hit, closer to home here, we are continuing to hear about the impact of the upcoming return of student loan repayments. Are you worried about that impacting consumer transactions and foot traffic to your website?
Well, for us, I think the big thing that drives our website is really the buying and selling of the stuff from our closets. So in that sense, it's not a huge issue. The part that is amazing about the Poshmark economy is that you have millions of closets that can really cater to these fast-moving trends and allow people to circulate the things. So we're not super worried about it because our consumers are really both the buyers and the sellers on the platform.
All right, that was Poshmark CEO Manish Chandra speaking on the e-commerce landscape as part of Yahoo Finance's week-long special, Retail Evolution, the New Era.
Well, Disney going on offense in its battle with Florida Governor Ron DeSantis. Yahoo Finance's Alexandra Canal is joining us now with those details. Allie.
Hi, Shauna. Well, another day, another development in this ongoing DeSantis versus Disney feud. The latest being that Disney has now countersued DeSantis's oversight district, or what was formerly known as the Reedy Creek Improvement District. Now, it's important to note that this filing is separate from the federal case that Disney launched against DeSantis earlier this year, but similar points are made. Now, in this filing in particular, Disney filed an answer to the Oversight Board's lawsuit, along with listing 9 new counterclaims that allege the board is in breach of 2 contracts it secured to develop and maintain control of its 25,000-acre land, aka what was formerly known as Reedy Creek. Now, this was the special tax district that allowed Disney to operate as its own self-governing entity. But after entering into those contracts, DeSantis removed Disney's handpicked Reedy Creek board members, and Florida lawmakers retroactively invalidated the contracts. So Disney now is asking for unspecified monetary damages exceeding $50,000, and for the judge overseeing the case to force the new district board to comply with what Disney says are its duties under the agreement. So breach of contract, certainly number 1 here, but Disney is also alleging that the board's actions violate its free speech rights protected under Florida's state constitution. And we know that was a very big sticking point in Disney's federal lawsuit. So just a lot to keep up here. There have been multiple lawsuits, countersuits throughout the course of this, both on the state level as well as the federal level. And of course, this comes just a few days after Ron DeSantis signaled in an interview earlier this week that he wants to end the feud with Disney and that he has moved on, wants Disney to drop the lawsuit. But clearly that doesn't seem to be in the cards, at least right now.
Yeah, certainly. Well, it doesn't look like Disney's going to let DeSantis walk away that easily. All right, Allie, thanks. Well, coming up, Americans are paying more for childcare with the cost of care rising faster than inflation. We've got more on that next.
Fed officials descending on Jackson Hole next week for the Kansas City Federal Reserve's annual economic symposium will face the question of whether inflation is on a convincingly downward trajectory or whether more interest rate hikes are needed to bring down inflation. Inflation has cooled on a headline basis from a peak of over 9% last June to just over 3% this July. But stripping out volatile food and energy prices, inflation sits over 4%, double the central bank's inflation target of 2%. In his last comments at the Fed's policy meeting in July, Fed Chair Jay Powell wasn't convinced on inflation yet to let off the gas and said he needs to see leftover distortions from the pandemic on supply and demand ease.
Policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate.
Traditionally, Fed chairs have used their speeches at Jackson Hole to put forth major policy messages. This year expected to be no different, with investors hanging on Powell's every last word.
A new report highlighting that the average teacher could afford just 12% of the homes near where they teach, and that might not change anytime soon. Here to talk about what can help teachers afford more homes is Yahoo Finance's housing reporter Rebecca Chen. Rebecca?
Hi, yes. So we have seen the data that shows teachers on their average salary could only afford about 12% of homes, and that is a dramatic drop from 2019 when it was about 30%. So here we want to present some options for teachers that they could utilize to purchase that home for them. And the first one that we really want to shine some light on is a government-funded program out there known as the HUD's Good Neighbors Next Door. And what it does is if you were to go onto their website, and you can get 50% discount on a home in a revitalized area. Now, let's look at this listing together. This is one that is in Colorado currently, and it's listed for about $300,000. So if you were to get this listing, you could get it about at a discount of 50% off. But there are some requirements to qualify. First, you have to be a public worker, and you have to be working full time and work in the area that the house is located in. So you can't. It's not just anywhere. And also, you have to live there for at least 36 months as your primary residence. We spoke to them just yesterday, and they said that given that there's an inventory shortage all across the nation, they have really seen a supply crunch on their listing. So if there is something that you like, you can make a bid on it as soon as possible. And the expert really recommended that if you are looking to join this program, check the listing weekly or even daily to see if there's anything for you on this website.
Rebecca, when it comes to some of the other options out there, because not all teachers are going to be able to take advantage of that offer, given the fact that it's in select areas, what else could some of those teachers who aren't able to take advantage of that do?
That's right. That's a valid question, because for teachers and educators who want to look in places that maybe not in a revitalized area, our experts are saying you can really look at other public programs such as a Fannie Mae mortgage loan. They have something called a Home Ready application for buyers. And how it really helps is it only requires a down payment of as low as 3%. And on top of that, they have tools that can help you work with you and your family to come up with that down payment, whether it be going through a grant or having some sort of equity from different places. But they can help you pull different resources together to get that down payment together. And also, other than the federal government, depending on what state you're living in, there can be a program in your state that also helps you as a teacher. For example, the state of California very recently had something called the Extra Credit Teachers Home Buying Program. What it did was it provided grants for teachers as a down payment on the houses that they're looking at. So although that program has been discontinued, there has been a variation of that throughout different states and throughout different years. So really check your local county and your state on top of the federal government program to see what you can utilize, and just to find that house of your dream and for the best bang for your buck.
All right, Rebecca Chen, thanks so much.
While economists and investors cheer slowing inflation, it's not all a rosy picture. The cost of childcare in July CPI report rising 6% last month. That's double the overall reading, and the effect of these higher costs could ripple through the rest of the economy. Joining us now to talk a little bit more about that, we want to bring in University of Notre Dame economist Chloe Gibbs. Chloe, it's good to see you. So speaking from personal experience, I'm a mom of 2 boys. I pay a heck of a lot per month in childcare. Many Americans are having a tough time given the fact that it's rising at least so much quicker here than that overall inflation number. Why is that the case?
That's right. So, and I want to also sort of just back up, even that this was an issue prior to the pandemic. Mm-hmm. And so even in the 3 decades preceding the chart that you just showed, we experienced this issue of childcare prices growing faster than overall prices and growing faster than median income. And so many families are feeling that pinch that you described. I'm a mom of 4. I also know that pain. And there's a variety of reasons that we think that this is occurring. But I think the one that I'd like to emphasize is that the childcare industry is a labor-intensive industry. Obviously, it's really important that we have caregivers taking care of kids. It's not something that can be automated. And because of the tight labor markets that we've been experiencing over the past several months, couple years, childcare workers, staff in childcare establishments have more outside options. They can command higher wages. And so one thing that we've seen is a lot of exit from childcare employment. It also makes it hard on the providers who really only have 2 options to raise profits, which is to either increase prices that families face or to decrease the wages that they pay, which really isn't an option given the state of the labor market right now. So we see this feature of the childcare market playing out that is a persistent gap between the cost of providing high quality care and the prices that families can afford.
And Chloe, I want to ask you about, are there any solutions to this problem on the horizon? I'm also a mom. I just have one. Hats off to you, both of you. I got to ask, like, what are the solutions that can come into play? Because, you know, childcare does take a big chunk of your budget. I mean, the average that I'm seeing is, you know, it's more than 10%. In a lot of cases, it's more than that. Some people are paying 30% of their budget, what you should be allocating for housing. Some people are paying more for childcare than they are for their shelter. What are the solutions that we're hearing out there, or what is a potential solution to this problem?
Yeah, it's a great point, and you mentioned how this burden is differential across the income distribution. So lower income families are feeling this bite much more, in that often a quarter of their income is allocated to childcare costs. And I'll also just mention that this hits a lot of families. So 60% of children under the age of 6 are in some form of non-parental care on a regular basis. And that's not even looking at school-age kids who might require before care or after care around the school day and in the summers. And so this is hitting a lot of families. And some of the solutions, I think, there are some that will naturally occur as we see inflation decelerating. That does lower the costs that providers face in terms of their utilities, their rent, some of the other expenses that they have in addition to labor. So we might see that childcare prices that slow down in that growth might continue to slow as we see that happening with overall inflation. And I think there's also some important investments we can make. We help families, particularly lower income families, afford this big cost, because it often hits families when they are at the lower part of their lifetime earnings trajectory, right? They're early in their careers because they're relatively young when they have young children. And so we have subsidy programs and subsidized care that help to sort of smooth that for families. I think one thing we could consider is sort of looking further up the income distribution, because families further up the income distribution are experiencing the burden of childcare costs. And then I think we really also have to think about the supply side. So that is the childcare providers. The federal government invested a fair amount in providers via the ARP childcare stabilization funds. Those funds are going to expire pretty soon. Most of them have been spent. And so that was, intended to help childcare providers weather some of these economic challenges present. And we know that they are less buffered from economic headwinds than other industries. And so we might consider, what are the other sorts of incentives we can invest in the system to keep providers in the market, to keep them providing high quality care for families, because it has real economic implications that ripple throughout our economy.
And what does that look like, Chloe? Because we talked a lot about the fact that so many Americans simply can't afford childcare, and we've seen more and more women drop out of the workforce as a result.
That's right. And I think we have a lot of evidence that suggests that when we subsidize childcare, when we make it more accessible, more affordable to families, we see women enter the labor market. And so, we know that women's participation in the labor market over the last many decades has contributed to GDP. I think we should be worried about whether we are really capitalizing on labor supply and getting all parents who would like to be working while also caring for children into the labor market, because they can find the kind of care and afford the kind of care that would facilitate that.
Such an important issue. Chloe Gibbs, thanks so much for taking the time to join us.
Thanks for having me.
All right, time now for what to watch next week. NVIDIA's second quarter results will be a big test for the massive AI rally. The AI frenzy sending the stock soaring up nearly 200% this year. And the street is getting more bullish with UBS, Wells Fargo, and Baird among the names raising price targets ahead of the results. Morgan Stanley reiterated NVIDIA as the top pick and sees the recent sell-off as a good entry point. We will also get more earnings from the retail sector. Lowe's is on deck. Investors are closely watching demand trends after rival Home Depot saw sales decline. Dick's Sporting Goods will also release results, giving investors another look at demand for clothing and sporting goods. Then later in the week, it is all about the Federal Reserve. Fed Chair Jerome Powell will speak at the Jackson Hole Economic Policy Symposium on Friday. Powell will deliver his economic outlook at 10:05 a.m. Eastern, and Wall Street will be listening for any clues on future rate decisions. Be sure to tune in to Yahoo Finance's coverage of Jackson Hole.
All right, well, coming up next, we are counting down to the closing bell on Wall Street. Not too much movement here for the day, but it certainly has been a week of losses with all three of the major averages on track to close the week in the red. We've got more on that coming up. It was a busy week in retail. Results from Home Depot, Target showing struggling sales, while Walmart, TJX, and Ross excelled as they benefit from shoppers looking for deals. We certainly got maybe a mixed overall picture when you take a look at those headline numbers. But my big takeaway, Diane, from the week is that the consumer is still resilient. It's one of the themes that we have been talking about for months and months and months now. We've been waiting to see more cracks. When you take a look at those spending numbers, they were pretty impressive given the macro environment.
Resilient but choosy about where they're going. They're like, okay, I need to get more bang for my buck right now because, you know, they're choosing. They have to, obviously, they have to spend on food. So Walmart did well there. We know Walmart's annual revenue is about more than 50% of that comes from grocery. So they were positioned well for this quarter. Target certainly felt the effects of not doing as well in terms of their grocery revenue is about a fifth a fifth of their revenue. TJX doing well as well, you know, when you think of that discount play. When we've seen problems in the economy or any kind of slowdown in the economy, you start seeing that TJX play working out better, right? But, you know, and again, like that does tee up lows next week for what are we going to watch for there when we think about Home Depot in that perspective. But I see, yes, the consumer is resilient, but it's a tale of two retailers in terms of who are the winners in this kind of environment, who is positioned the best as the consumer starts to have a few cracks in the armor.
Yeah, and we also heard that from Walmart, from the CFO there, John Rainey, saying that they are seeing an uptick here in the higher income shoppers, because even when you take a look at the higher income earners, they're feeling the pressure from inflation and they're choosing to trade down because they're seeing the need to tighten some of their spending budgets here. But when you take a look at Walmart's numbers, it was interesting, the stock reaction right after this solid report, because I think a lot of this good news had already been priced in year to date. You're looking at gains of just about 11%, but U.S. store sales up 6.4%. Average transactions and the number of items also rising here. Number of items bought rising. Customer traffic was up 2.9%. So we're seeing those retailers, like you're saying, that are positioned, that are offering the best discounts and the best pricing out there, outperform in this type of environment.
Don't forget e-commerce for Walmart, up 24%.
Let's take a look at the closing bell. We want to do a check-in of the markets. Not too much movement here as you look at the overall closing numbers, not too far from the flat line, I should say, with the Dow up just around 27 points, S&P right around the flat line, just in the red. You're looking at the Nasdaq off about 0.2%. But when you take a look at those weekly numbers, the Dow off more than 2%, having its worst week that we've seen since March. The S&P and Nasdaq lower for the third week in a row. And both of those major averages, the S&P and the Nasdaq, both on track for having their worst month that we've seen since December. So some risk-off sentiment really hurting the broader equity market. And we're seeing losses for the week across the board with the major averages.
Speaking of that sentiment, a wave of volatility striking across the crypto space. Bitcoin sliding deeper into the red as it briefly dropped below 26,000, marking the biggest one-day change this year. Now, investors looking at several potential reasons for the decline, including that continued risk-off trade that we talked about. There was also obviously that news about SpaceX and selling some of its Bitcoin holding, well, more than some, a chunk of that, and that potentially being an inflection point for Bitcoin. And you seeing that route not just affect Bitcoin, also Ethereum as well. And so just this downdraft across these riskier assets, right?
Yeah, certainly. And we are seeing it hold above, we mentioned earlier, 25,000 being one of those critical levels that we are seeing a lot of focus on, just the need to stay above that level. If it does break through or fall below that level, obviously that could mean that we're in for a larger pullback. But remember, this is a asset that's up 60% since the start of the year. But you've got this environment right now where we're in rising yields, regulatory pressures, also weakness out of China, certainly headwinds for some of these riskier assets like Bitcoin is typically viewed. And then you also, like you just said, the news from SpaceX selling its Bitcoin holdings, that of course is also weighing on sentiment. So we saw that obviously reflected in the price today and the price the last 2 days and really for the week. So we'll see whether or not we're able to hold above 26,000.
I know it'll be a key level to watch.
It is a key level to watch. All right, let's also take a look at another stock here that got our attention today. Starboard Value taking a stake in Bloomin' Brands. Now, activist Starboard now owning nearly 10% of the Outback Steakhouse parent company. Shares here jumping 8%. We're looking at the biggest gain that we've seen now for quite some time. We don't know the specific changes that Starboard wants to make here when it comes to Bloomin' Brands, but Diane, they have been successful in the restaurants sector in the past. When you look at the history that they had with Darden back in 2014, and the street's excited that they are entering and buying that stake of 10%.
I guess is this a missed opportunity for Bloomin' is blooming the stock? I'm sorry, right? You had to.
For now, at least.
Right, for now. I mean, yes, it's clearly a bet on what, they did this. Starboard had success with Darden. When they got involved with Darden, shaking up the board there, you saw a huge run up in the stock price. I mean, up sharply. I mean, it's back in 2014, up, what is it, around 200% since then. I mean, you just saw this steady climb higher. There was a brief dip, obviously, as many saw a dip in 2020, or sharp decline rather there. But overall, the involvement of Starboard was very helpful in rewarding shareholders, right? So that is clearly the play here. It's a bet on what can Starboard do for Bloomin'.
Yeah, and we've also just seen across the board a surge in activist activity. We've talked about that a couple of times since the start of the year, but Barclays was out with a recent note saying that activity in the first half of the year hit a 4-year high. So we're started to see that trend earlier this year. We'll see whether or not it holds in the second half.
Yeah. All right. Consumer spending in the U.S. remains strong despite inflation and the Fed's fight to cool the economy. Many analysts are now pointing to a soft landing for the economy. For more on what that could mean for President Biden ahead of his re-election fight, we turn to Yahoo Finance's own Rick Newman. Hi, Rick. Happy Friday.
Hey, guys. You were talking about strong retail sales earlier. That was the big story this week. Everybody seems to be raising their GDP forecast. The Atlanta Fed GDP Now tool is saying GDP for the third quarter could be 5.8%. That metric often overshoots. But, I mean, come on, that's almost 6%. So why is this happening and what is going on? And I think the important question is, can this last? And the possible answer is it may not last. There is another interesting thing out this week from the San Francisco Fed. This was an examination of this phenomenon we've seen in the aftermath of COVID that economists call excess savings. So when Americans were stuck inside during the pandemic, they saved something like maybe $2.1 trillion more than they would have saved if we were in a normal economy. And for the last year and a half or so, they've been spending that down. And that is one of the things that has really kept spending buoyant. So guess what? That $2.1 trillion is probably now down to less than $200 billion, according to this analysis by the San Francisco Fed. It's falling by about $100 billion per month, which means by the fall, that excess savings could be completely gone. And at that point, what is going to fuel this super strong consumer spending? Who knows? Consumers are very hard to predict at this point. Things are not going according to the usual patterns in the aftermath of COVID. But that is one thing that could bring a slowdown. And of course, President Biden has dodged a recession so far. He needs to get through about another year or 15 months before the next election. Will he make it? These are going to be the factors that determine whether he does.
Speaking of that point about him dodging a recession, so Rick, if we only see a short, shallow recession, or say we don't see one at all, how would that impact Republican arguments against Biden during this campaign season?
The Republicans possibly have been making a mistake by attacking Biden on inflation. Think about the old adage, you have to skate to where the puck is going and not skate to where the puck is. Well, inflation is going down. And we know from a lot of analysis of presidential elections going back decades, what really matters for an incumbent president is the state of economy around this time in an election year, 3, 4, 5 months before the election, because that is when voters are the ones who are on the fence anyway, are making up their minds. Should we give the guy in office another 4 years, or should we give him the boot? So if there's a short recession and a mild one, that could put us in a recovery by, next spring or next summer, that might be fine for Biden. I think the thing that the White House probably worries about is that the recession that has been delayed by quarter by quarter by quarter, that it might actually materialize, let's say, next spring or next summer, which would be terrible timing for Biden. But you know what? He can't really control that as much as he wants to pretend that he deserves all the credit for everything that's happening in the economy. The president does not control the economy very much. So he should just enjoy the economy we have today because it's pretty good.
All right. That's a great place to put a pin in it. Rick Newman, thank you so much. Have a great weekend, Rick.
Happy weekend, guys. See you.
Shares of Palo Alto Networks trading up just about 5% right now after reporting Q4 earnings. Now, lots of hype going into this report. Let's first get to the numbers, then I'll tell you why. So when you take a look at this report, it was mixed on the top and bottom line. You're looking at sales coming in at just around $2 billion. That beat the street's expectations, I believe. When you take a look at sales, missing here just by a bit. 1.95 billion. Estimate there was for 1.96 billion. EPS, though, coming in better than expected, $1.44. Estimate was for $1.28. But the guidance here is really what's critical. And I think it's almost a sigh of relief that we're seeing from the street, because they were bracing themselves for a disastrous report. But 2024 billings forecast, 10.9 billion to 11 billion. That beat the street's expectations of 10.77 billion. When it comes to Q1 revenue outlook, though, that coming in just a bit light here. When you take a look at what they are expecting there, they see Q1 revenue 1.82 billion to 1.85 billion. The street was looking for 1.92 billion. So billings forecast topping expectations. We saw the stock sell off over the last 2 days or so because there was lots of concern about what we will be hearing in this report. So let's get analyst reaction to that. And we want to bring in Ray Wong, Constellation Research Principal Analyst and Founder. Ray, your first take.
Yeah, they put out a Friday night special. Everybody got nervous. It felt like it was going to be some kind of political campaign where you make the announcements on a Friday and hope no one notices on the weekend. But I think it was really a lot to do with Fortinet having bad forecasts going towards the future. And I think that spooked everyone on the market. But the good news is that they're doing well. They're definitely one of the leaders when you look at enterprise security. And if you look at cybersecurity stocks, the challenge is the macro environment. Budgets are being redirected from AI, from cybersecurity to AI. And that's really the challenge in every single organization. Boards are going to AI first, and it's having an impact across the sector. They've managed to weather this AI onslaught much better than everyone else. And that's why their forecasts are where they are.
So, Ray, I know one of the concerns coming into this was, there could possibly be an executive change, or, it was just very dramatic coming into these results. I mean, you rarely see this, what we usually call a Friday night, data dump. So given that where it is, we kind of see a sigh of relief in the aftermarket. What do you think about, what are you expecting to hear on their earnings call? What are you looking for?
Yeah, I think people want to understand if CISOs are still buying. I think they want to understand if there's an AI story that's going to be in place, which they do have, which is going to make it easier for CISOs and enterprises to manage their environments. They also want to know, what they're doing to cut costs as well going forward. So everyone's been on their cost posture. I think those are probably the three important things. The larger macro forecast in general is it's hard to beat the comps of the last 2 years. Everybody doubled down on cybersecurity like there was no tomorrow. And trying to match those comps aren't an easy thing to do.
Right. Where do we stand in the broader space? Because when we talk about so much concern going into this report, yes, they were reporting after the bell on Friday, but also their competitor, their rival Fortinet, also reported disappointing results. So what does this tell us just how Palo Alto is positioned among the broader industry?
I think it's because Palo Alto has a broader portfolio. And when you look at what's happening inside every enterprise right now, they're trying to reduce the number of vendors they work with. They're trying to reduce the complexity, which means the integration cost of working with more than one vendor. And so what Palo Alto has done is probably put the best portfolio in the marketplace for customers to buy so that they don't have to go to all these different point solutions. And I think that's really where their strength has been, is managing that portfolio better than everyone else, managing M&A better than everyone else. And that's where the inherent advantage is.
And so, Ray, I want to ask you, in terms of where the stock stands, it's obviously there was a lot of selling heading into this result. Do you think it's positioned for greater growth through the balance of the year?
I think it's going to be challenged for the rest of the year. We do have a great dip at the moment. I think the rundown that was going on here, I think they were down 19% for the year, and the Nasdaq was down about 7 to 8%. It's a good time if someone had got in like today, so they're a little bit late there. But I would say that it's going to be flat for a while because the forecasts going forward for Q3, Q4 are all impacted by everyone running to AI and spending the money and budgets in AI. And that's really the challenge. I think going forward, there's going to be other kind of security threats are going to be in place. And of course, the spending on cybersecurity has always been pretty strong. It is the number one issue every CIO focused on last year. It is now the number 2 issue because of AI.
All right, Ray Wong of Constellation Research, thanks so much for joining us for a Friday night special. Have a great weekend.
Happy weekend.
Thank you.
It's closing time here at Yahoo Finance Live, and here's a look at some of the top stories of the day. SoftBank reportedly buying a 25% stake in chip designer ARM Holdings. The Wall Street Journal reporting that SoftBank acquired the stake held by Vision Fund. The deal values ARM Holdings at just over $64 billion ahead of its highly anticipated IPO, which is expected to be the largest deal of the year. Another change is coming to X, the social platform formerly known as Twitter. Elon Musk posting on the site that it will be removing the ability for users to block other accounts. Now, he said blocking would still be possible in direct messages. People use blocking as a safety tool, allowing users to protect themselves from unwanted interactions on the platform. Now, it is unclear why Musk is making this change or when it's going to start. And former President Donald Trump reportedly skipping the first Republican primary debate. The New York Times saying that he will pass on the debate that is slated for next Wednesday in Milwaukee, and instead will sit down for an interview with Tucker Carlson. Other reports say it's not a done deal quite yet, and he could change his mind. That does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a great weekend. Not tomorrow, Monday.
Monday.
It's Friday, thank God.